may have heard a lot about leverage trading or CFDs recently. Here is some useful information that will help you understand this popular investment strategy.
CFDs, or contracts for difference, are contracts between buyers and sellers that allow investors to potentially benefit from the price movement difference of assets without actually buying or owning the underlying assets themselves.
When you trade CFDs, you aren't buying and selling actual assets like stocks or crypto.
Instead, you're taking a position on the price movement of a specific asset.
CFDs
are derivatives.
Derivatives aren't the asset itself, but track the price of the underlying asset like ETFs, stocks, or crypto.
CFDs open up new investment strategies that were previously only available to highly experienced institutional investors.
One of these strategies is leverage trading.
Leverage trading is like using a magnifying glass on your money. You put up a small amount, margin, to control a much bigger position with the aim of multiplying your gains. But be careful, because this works both ways, and losses get magnified too. Leverage trading means that you can hold a trading position that is worth much more than the amount of money you invest. This increased exposure means potentially higher profits, but you could also incur higher losses. So, why are CFDs and leverage becoming more relevant? It all has to do with market volatility. If used correctly, leverage strategies can help you make the most of that volatility. For example, if you expect the price of an asset to go down, you can go short, meaning potentially making a profit when the price goes down. Or if you expect prices to go up, you can go long, meaning potentially increasing your profits. BitPanda Leverage gives you access to over 10 leverage positions. You have the option to go 1 time short or 2 times long on Bitcoin, Ethereum, and other top crypto assets. For example, if Bitcoin price goes up 10%, the price of Bitcoin 1 time short will decrease by up to 10%, and the price of Bitcoin 2 times long will increase by up to 20%. This means you can open up a short position on an underlying cryptocurrency if you think crypto price could go down, or a long position if you expect prices to rise. BitPanda Leverage makes the most out of short-term volatility by allowing you to trade in the crypto market if prices go up, but also if they go down. And did we mention that the buy fee is 0%? You will only be charged a 1% sell fee when you close your position, and the overnight fee is just 0.1%.
When it comes to CFDs and leverage trading, risk is an important part of the conversation. That's why with BitPanda Leverage, we give you the tools to help mitigate some risks. Re-leverage. In regular leverage trading, you borrow from the exchange to trade with, and if the price drops too much, they can take your collateral and sell it to cover the loss. This is a liquidation. With BitPanda, we re-leverage to maintain the target leverage ratio of 1.9 times for long positions on your behalf, at least once per day, to ensure you do not lose more than you invested. And we will never ask you to provide any additional collateral. Additionally, BitPanda Leverage puts customers' interest first. There's a 50% stop loss mechanism which ensures your position will automatically close if a 50% loss has been incurred. Long story short, when used correctly, BitPanda Leverage can be a useful strategy to diversify your investment portfolio. You can increase potential return on crypto investments in time of volatility with a 0% buy fees. However, the risk of losses are also higher, so make sure you conduct your independent research before investing and that you follow your investments closely.